Here's something you never hear about your money. Right now, the entire global economy is running on a single fragile assumption that the dollar will always be king. But what if that assumption is wrong? What if the anchor holding everything in place suddenly just slips? You might think that's a fantasy, but the cracks are already beginning to form. And what happens next will rewrite the rules of power, trade, and your own financial future. Let me show you how. Imagine a world where the US can't just borrow endless money at the snap of a finger, where the magic checkbook suddenly bounces. Now imagine that world is already here, moving in slow motion. The first domino hasn't fallen, but it's already tilting. This isn't some doomsday prediction. This is based on cold, hard data from the IMF, central bank reports, and geopolitical analysts who watch this chessboard every day. And the unsettling part, we got a tiny taste of this shift in 2022 when sanctions flew. The global payment system, which is supposed to be neutral and open, became a weapon. Countries realized their dollar reserves could be frozen in an instant, and a quiet, desperate scramble for alternatives began behind closed doors. So today, I'm going to walk you through exactly what happens as the world's reliance on the dollar unravels. Not just the currency trades, but the whole chain reaction. How it affects your cost of living, global stability, your job security, and even the price of the goods on your shelf. By the end of this, you're going to see the news in a completely new light, and you'll understand why the next decade will look nothing like the last. Let's start with the bedrock. The petrodollar system is the engine. We're talking about oil being traded exclusively in US dollars for decades. That forced every country to hold huge dollar reserves. Think of it like a global membership fee. To buy energy, you needed dollars. To get dollars, you had to trade with America. Now here's the crucial part. That system is no longer exclusive. The biggest oil producers are now making deals in other currencies. China buys oil from Saudi Arabia in yuan. India buys from Russia in rupees. These are not small one-off trades. They are deliberate, structural shifts. Why are they doing this? There are a few reasons. First, geopolitical leverage. Relying on the dollar means relying on US political goodwill. For rival nations, that's an unacceptable risk. Second, transaction costs. Why should a Brazilian company buying Indonesian goods have to convert their money into dollars first? It's an expensive, inefficient relic. Cutting out the middleman saves billions. Third, there's something called monetary sovereignty. When your country's financial health is tied to US interest rate decisions made in Washington, you lose control. Breaking free from the dollar is like declaring financial independence. This system has been in place since the 1970s, but this whole setup depends on one thing. Everyone has to keep using dollars. They have to keep pricing commodities in it. They have to keep stockpiling it as their primary reserve. The second they find a viable alternative, the entire landscape shifts. Let me explain how this network, the architecture of global trade and dollar dependence, actually functions because it's more intricate than it seems. When a South Korean company imports German machinery, the invoice is in dollars. Not won, not euros. Dollars. This creates a constant underlying demand for US currency that has nothing to do with buying American products. The players in this system aren't just companies. There's a whole ecosystem. First, you've got correspondent banks, financial institutions that hold accounts for other banks in different countries to facilitate international transactions. Banks like HSBC, Standard Chartered, and Citi. These banks are the plumbing of global finance. They process the dollar payments. Then you've got sovereign wealth funds and national pension plans. These entities manage a country's long-term wealth, and they've always parked a huge portion of it in ultra-safe US Treasury bonds. Then you've got the central banks, the Federal Reserve, the European Central Bank, the Bank of Japan. They hold dollar reserves and use them to manage their own currency's values. And finally, you've got the currency swap markets. Trillions of dollars are exchanged here daily to hedge against currency risk for corporations. Now here's where it gets critical. All these different players have different motives. Corporations want efficiency. Central banks want stability. Sovereign funds want security. But they all depend on one thing. They depend on the dollar's value being predictable. Predictability is everything in international trade. A company signing a contract to deliver goods in 6 months needs to know what its costs will be in 6 months. If the dollar is volatile, that becomes impossible. But that predictability depends on everyone having faith in the US government's ability to manage its finances. After the 2008 financial crisis and the massive stimulus that followed, that faith began to erode. Countries saw the US printing money to solve its problems and started to worry. This is exactly what happened in the 1970s when the US went off the gold standard. Inflation spiked, the dollar weakened, and it took a painful period of extremely high interest rates to restore confidence. So imagine that scenario. But instead of a temporary crisis of confidence, it's a permanent structural decline. Major economies that trade trillions decide they're building new payment rails. What happens to all those dollars? What is their new purpose? The first thing that happens is a slow but steady devaluation. Think of it like a company's stock when a major investor starts quietly selling their shares. The price doesn't crash overnight, but the downward pressure is constant. And when a currency's value drops, the cost of imports goes up. That's just how exchange rates work. A weaker dollar means you need more of them to buy the same Japanese car, the same Italian suit, the same German machine part. Let's say key trading partners start pricing their exports in other currencies. Not all at once, but steadily. Maybe a few major contracts a month shift away from the dollar. That might not sound like much compared to the trillions traded daily. But remember, it's not just about the total volume, it's about the momentum. It's about the signal it sends to the rest of the market. The dollar's privilege is its network effect. The more people use it, the more useful it becomes. But that works in reverse too. Now imagine the buyers who usually demand dollars for their goods suddenly start accepting other forms of payment. That's a huge shift. Someone has to absorb the excess dollars. Who's going to hold them? The Federal Reserve can't just destroy them. They can try to support the currency with interest rates. But remember, they have a dual mandate. They need to worry about employment and growth at home. Raising rates too high to defend the dollar could crash the US economy. Foreign central banks might hold some to avoid their own currencies, appreciating too fast and hurting their exports, but they have their own limits. They don't want to be the bag holder for a depreciating asset. Domestic investors are stuck with them, but as the world's demand for dollars falls, its value falls, and the real purchasing power of American savings erodes. So what actually happens? Inflation becomes structural. If the dollar's share of global reserves drops by just 5 percentage points, research suggests the pass-through to consumer prices could add 1 to 2% to the annual inflation rate. That's the estimate for a gentle shift. If the transition accelerates, we're talking about a sustained period of higher inflation, not caused by an overheated economy, but by a fundamental loss of currency value. We're talking about inflation settling not at 2%, but at 4, 5, or even higher, becoming the new normal. Now think about what that means. Persistent higher inflation erodes savings. It forces the Fed to keep interest rates higher for longer, which stifles business investment and weighs on stock markets. It creates a cost of living squeeze that hits middle and lower income families the hardest. But it gets worse. A weaker dollar also means falling real wages for Americans. Even if you get a 3% raise, if the cost of the imported goods you rely on rises by 6%, you've effectively taken a pay cut. The standard of living slowly declines. We saw a glimpse of this in the 1970s. Stagflation, high inflation combined with high unemployment. It was a miserable, demoralizing economic period that took a brutal recession to cure. Now multiply that scenario across a globalized economy. If the dollar's role diminishes because countries diversify, every American who buys anything made overseas feels the pinch directly. And it's not just consumers. Companies that rely on imported components see their costs rise, squeezing their profit margins. They either absorb the cost and invest less, or they pass it on to consumers, fueling the inflation fire. This is how you get a negative feedback loop. Higher prices lead to demands for higher wages, which lead to higher business costs, which lead to even higher prices. The economy gets stuck in a vicious cycle. The other immediate effect is on capital markets. The US stock and bond markets are the deepest in the world, partly because everyone needs dollars to invest in them. If the world needs fewer dollars, the demand for US assets falls. Foreign capital that once flowed into US tech stocks and corporate bonds starts to dry up or seek returns elsewhere. This doesn't cause a sudden crash, but it puts a permanent ceiling on valuations. The era of cheap capital for US companies could end. Companies would find it more expensive to raise money for expansion and innovation. Growth would slow. The pace of technological advancement could slacken. This is systemic change at its most profound. So we've established interest rate dynamics and the end of cheap capital, that inflation would become embedded, and capital would become more expensive if the world moved away from the dollar. But let's dig deeper into what that means for American power and the government's ability to project influence. The US government's ability to run large deficits is uniquely supported by the dollar's reserve status. It's like having a global credit card with an almost limitless limit. When you need to fund a military operation or respond to a crisis, you can borrow trillions easily because the world is eager to lend you their dollars. Here's the problem. If foreign demand for dollars and US debt declines, the government faces higher borrowing costs precisely when its ability to lead is being challenged. You'd get what's called a fiscal squeeze. The money for grand projects and global security commitments dries up. Normally, a country might retrench, focus inward, and cut its global role, but for the US, that creates a power vacuum. Other actors with different values and interests step in to fill it. The Federal Reserve would lose its role as the world's central bank. They could try to fight the capital flight by offering higher interest rates on US debt, but there are limits to this. First, the US debt load is already unsustainable. Paying much higher interest on that debt would force brutal trade-offs between military spending, social programs, and debt service. Second, if the reason foreign investors are leaving is a loss of confidence in US political stability or long-term fiscal health, then higher interest rates are just a sticker on a broken window. They don't fix the underlying structural issues. In fact, they might make it worse. Higher debt service costs exacerbate the deficit, which further erodes confidence. It's a trap. The government wants to maintain its global role by borrowing, but borrowing too much undermines the very foundation that makes the borrowing possible. The alternative is to accept a reduced role in the world, but that brings its own dangers. A multipolar world is a more complex and often more conflict-prone world. Without a clear global leader, disputes over trade, territory, and spheres of influence are harder to mediate. Alliances become more transactional and less stable. This is the great irony. The exorbitant privilege of the dollar gave America the power to shape the global order. The loss of that privilege could unravel the order itself. The US would also struggle with the tools of financial statecraft. Sanctions are a powerful weapon precisely because they can cut countries off from the dollar-based financial system. If significant trade occurs outside that system, sanctions lose their bite. Rogue states and adversarial powers can operate with greater impunity. The deterrent power that has underpinned US foreign policy for decades weakens. There's also the problem of the Triffin dilemma. This is a classic economic paradox, where the country that issues the reserve currency must run persistent trade deficits to supply the world with its currency. This ultimately undermines the value of that currency over the long term. The US has been living this dilemma for 50 years. We supplied the world with dollars by buying more from them than they bought from us. This deindustrialized parts of the US economy and created the massive trade deficits we see today. Moving away from the dollar as the sole reserve currency would force a rebalancing. The US would need to export more and import less. That sounds good, but it's a painful adjustment. It means competing directly on quality and price in global markets, something many US industries have not had to do for a long time. It means some sectors will boom, but others that rely on cheap imports and a consumption-driven economy will struggle. This brings us to the bigger question: what happens to the global order when its financial foundation is no longer monolithic? The international security dimension and a multipolar world for decades, US military power has been underwritten by its financial power. The ability to finance defense spending through debt is a huge strategic advantage. If that financing becomes more expensive, hard choices follow. Do you shrink the Navy, delay modernization of the nuclear triad, reduce commitments to allies in Asia or Europe? Each of these decisions has geopolitical consequences. Allies who have relied on US security guarantees may start to hedge their bets. They might pursue their own nuclear capabilities, as Saudi Arabia has hinted, or align more closely with other powers, as some Asian nations are already doing with China. This doesn't mean war is inevitable, but the stable, predictable security environment that has allowed for globalized trade and growth becomes much less stable. History shows that periods of transition between global powers are rarely peaceful. The rise of the US to overtake Britain did not result in direct war, but it was accompanied by 2 world wars and a Great Depression. The world is now more interconnected, but the human impulses of fear, nationalism, and competition for resources remain. The most likely scenario is not a sudden collapse of American power, but a slow diffusion. The US remains the single most powerful country, but it can no longer dictate terms. It must negotiate, compromise, and form coalitions. This could be a healthier, more balanced system, or it could be a more chaotic and volatile one. The outcome depends on the wisdom and statecraft of leaders in Washington, Beijing, Brussels, and elsewhere. For the average person, this shift feels abstract, but its manifestations will be concrete. The price of gas will be influenced by deals made in Riyadh and Beijing, not just by OPEC and the US. The security of shipping lanes will depend on a delicate balance of power in the South China Sea, not just on the US 7th Fleet. The value of your retirement account will be tied to global risk perceptions that are no longer filtered primarily through a US-centric lens. Understanding this is not about fear, it's about clarity. The 21st century is not going to be a repeat of the 20th. The rules are being rewritten, and if you want to understand what comes next, you need to look at the money. Because when the world stops demanding dollars, it's not just a financial event, it's a historical pivot. And if you want to be ready for the world that emerges, you need to see the currents shifting beneath the surface.